because we were already observing the global supply chain shock taking place, and there were hotspots, and there were hotspots domestically because pieces of the economy were reopening in sometimes a rather difficult fashion. And the question for us was, are those going to be permanent effects or temporary transient effects? That's the question.
The judgment you took at that point was that it would be temporary. Okay.
Yes.
We then get to September 2021, and I think it's that fourth quarter that I find most interesting to look at retrospectively. So by now, inflation is now over your target. It's at 3.1%. You're still doing the 150 billion of quantitative easing at that point.
Yes.
We then get to November 2021, and inflation is now running at 5.1%.
Yep.
And you're saying, I'm now very uneasy about the inflation situation. Of course, that is the moment when the committee judged that some modest tightening of monetary policy was likely to be necessary. So it didn't actually move until a bit later on in the autumn, 0.1.
But we moved.
Yeah. So you're still at 0.1 at that point.
Yeah.
And then...
can I just observe that that's precisely the point in time that I was just referring to, with these two things that we were having to assess. One was the effect of the end of the furlough scheme, and of course, by the way, I said it ended at the end of September, but the data doesn't come through for another, couple of months. Yeah. And the second one is Omicron.
Yeah.
I mean, those are two things that were very much uppermost in our mind at that point in time.
I understand that, but you accept that monetary policy was kept very loose, despite the evidence that you gave us, is that there is risk that it transfers into real pressure in terms of wage negotiation,
yes.
The prolong inflation, lead to higher inflation expectations, all the things that we're currently seeing.
I perfectly agree with you on that. But the reason that I agree with you is because we were seeking to balance these various conflicting and countervailing pressures at that time, and to assess what was going on in the labour market as this million jobs on furlough unwound, as to how that would wind its way through. And those were very difficult judgments. And we concluded by December that the right thing to do was to start to tighten monetary policy. But we were still very uncertain because remember that was just about to go into the Omicron wave at that point.
Okay, so let's step forward then to exactly a year ago today. By now, inflation has risen to 6.2%. Interest rates are still only at 0.5%. And your evidence at that point is to say, I must say that transitory was becoming a slightly overused and in some circles overabused term. You're clearly now pointing to an upside risk, second round effects, the risk of real second round effects, and yet the rate is still only 0.5.
Well, the reason that I made the point about transitory goes back to what I said a few moments ago earlier on, which is that transitory is a term that, in my view, it's easier to apply to a single shock. By this stage, of course, we're now seeing, unfortunately, Russia's invasion of Ukraine, of course, was sadly starting to happen. Though the major impact on energy prices really came over the summer, actually, in terms of the impact. So we were seeking to judge what would be the impact now of more than one shock. And I also would just make the point that we were the first major central bank to tighten monetary policy. So, this was a problem and a challenge that others were having as well.
But on that day, the day before Russia invaded Ukraine, inflation was already running at 6% in this country, and interest rates were at 0.5%.
Yes.
And I wonder whether it is your opinion now, not with the benefit of hindsight, because these are all contemporaneous observations, that the risk to inflation was always more to the upside than to the downside, given the level of monetary policy that we had at that time. And the second round effects, the risks to those second round effects becoming embedded were very high at that moment in time.
But I think we were still, at that point, because of the nature of the shocks that we were dealing with and the question of how transitory they would be, that was the question that we were still, frankly, wrestling with at that point. And these are judgments we have to make, I'm afraid. We changed our view on that as we went through the summer, really.
How can people? I do want to keep on asking the governor. How can people feel confident, though, that the Bank of England has made the right judgments at the right time in this period of time? And I note that in terms of public polling, that there's now quite a high level of dissatisfaction with the track record of the Bank of England.
Well, our job is, I can quite understand the public polling, because our job is to get inflation back down to targets, and I would expect, the public will, of course, expect us to do that, and we will do it, and I would expect that will be reflected in public polling. So at this point in time, I would of course expect the public to say, well, it's your job to get inflation down to target, and my response to that is yes, it is, and we will do it.
No, actually, it's your job not to have let it get to this kind of level of second round effect either. I'm sorry to have to disagree on this point, but there's a very large body of first round effects going on at the moment. And one piece of evidence for that, we think, is that the fall that we expect to see in inflation this year, which we've set out in the monetary policy report, is the unwind of what we tend to call the base effects from last year. This is a very powerful unwind. Now, there's a second question which no doubt we'll come on to about will there be persistence? But these base effects are unwinding very powerfully this year, and they will unwind more as the year goes on because of the nature of what happened last year. That, to my mind, indicates that there is a very big first-round effect in here. Why? We'll get on to the second-round effects because, 5% now is the government's own target. It wants to halve inflation this year. A lot of the expectations you've set in terms of your forecasts of us getting back down to that level, I think what worries this committee is the persistence of some of those second round effects persisting at 5%. But I do want to
I'll say actually, as you've seen from the report we published, our projection just, indicates that inflation will probably come down below 5% by the end of this year.
You'll forgive the committee for being slightly sceptical of those projections, given how often we've seen those projections turn out to be incorrect.
Well, it's right for you to question us on those, and I accept that. What I would say is that there are really sort of two countervailing forces going on at the moment. There are very powerful base effects that are going to come out, effectively come out this year, and that puts a very powerful negative trajectory on inflation, unless we have some event in the world that we do not know about at the moment, and that's really down to a lot of that is down to energy prices. Now, we are concerned about persistence, and that's why we frankly raised interest rates this time, because you could justifiably say to us, if you've got this view of inflation going forwards, and of course we do take different views on this, as you'll know, and those of us at the table take different views on this. If you've got those powerful sort of downside forces, why are you raising interest rates again? And the answer for me to that question is I'm very uncertain, particularly about price setting and wage setting in this country. We have got the largest upside skew on it in our forecast that we've ever had on inflation, which still actually leaves it coming down to target, by the way. This is otherwise the central case would come below target. So we do put weight on the persistence risk, but there are very powerful downward forces this year, other things equal.
Thank you, Governor. I'm going to turn to Hugh now, and I know Silvana has a point that she wants to raise, and Jonathan as well. But Hugh, you've very kindly sent the committee a sort of self-assessment of your time on the committee since September 2021, and we're publishing that today. And I thought what was very interesting in your self-assessment is that it's slightly different from the speech and the evidence that you've given here in Parliament before, where you did stress this phrase about with the benefit of hindsight that we heard from the Governor just now. Because in your self-assessment questionnaire, I was intrigued by your paragraph 7, because you admit that in that pivotal time that we've been talking about, the autumn 2021 decision, that the bank waited for the end of furlough to tighten, and yet you point in that paragraph 7 to the fact that your network of agents at that time before the end of furlough was pointing to tightness in the labour market and strength of the ability of people to negotiate increases in wages. Can you tell us a bit more about this assessment you've made of how you should have paid more attention to that network of agents contemporaneously?
I think, first of all, let me say the assessment of which I wrote is one which is made with the benefit of hindsight. So I am assessing myself and looking back over the experience I personally have had since I joined the committee in September 2021. And I think what I'm trying to write is actually very consistent with what the Governor just said, namely, we were given this information from the agents at that time, and I think that information was published in the NPR and was part of what was reported in the minutes and all the usual vehicles of communication, I think, including the discussion that took place in this committee. I mean, speaking from a personal self-reflection, looking back, and I think consistent with what the Governor said, we faced at that time a very specific and a very uncertain environment in the labour market associated with the coming to the end of the furlough scheme. So if you remember, as we were unwinding, or as the government's furlough scheme was coming to an end, there had been some uncertainty earlier in the year before I joined the committee about when it would come to an end. That was largely resolved by this point. But in September and through that period, we still had roughly 750,000 jobs on furlough. And so the question, I think, was the tightness that was being reported from our agency network in the labour market associated with suggestions around recruiting difficulties and rising pressures in pay. Would that be eased at the moment that the furlough scheme came to an end? And, I mean, prima facie, at least potentially, you would release quite a lot of people who are supposedly in the jobs that were under the furlough scheme into the labour market. So that would have been a kind of corrective mechanism to this tightness. And with the benefit of hindsight, of course, I look back and think, how much weight did I place on the reports we were getting from the agencies versus how much weight did I place on the official data, which was reporting there are a lot of jobs still on furlough and therefore the potential for this easing. I think what I did at the time was think, well, we probably need to see, post the end of the furlough, how those close to 750,000 jobs that were furloughed, how that plays out in terms of both the survey data we see, the reports we get from the agents, and the official data. So data on unemployment, data on wage settlements, and so forth and so on. And I particularly put weight on the official data, which didn't come out, as the Governor just said, towards the end of November and early December. And so that led to a sort of view, this is a personal view, that it was worth waiting until we saw that data in order to avoid making a mistake about how tight the labour market would prove to be once the furlough scheme ended.
So I think official labour market data is always seen as a lagging indicator. You've got this marvellous network of agents that were telling you that the labour market was tight, and I wonder whether the fact that you were new to the committee meant that you didn't sort of speak up with your concerns loudly enough, and those were contemporaneous concerns that you had.
Well, I'd say to you, I mean, I was new to the committee. I don't think that precluded me from speaking up, but others are probably in a better position to judge than I am. And I mean, I want to make clear, and I think that was the purpose of this exercise, if I have not misjudged it, to me to give a personal reflection as an individual, independently accountable member of the MPC in the report I gave you, which you're referring to. So just to emphasise, that was a personal view. I would like to think, looking back, that I contributed to the discussion of the committee from the perspective I gave, but certainly the discussion in the committee, and I think this is what's recorded in the minutes, and I think was reported in the equivalent meeting back in November and then again in February 2021, was a discussion where this was at the core. And the point I'd emphasise is, I mean, looking back, the reports we were getting from the agents were the labour market is tight. The reports we were also getting from the agent market was there is uncertainty as to how the end of the furlough scheme will play out in terms of easing that. So in other words, it wasn't just those of us on the committee who were uncertain. It was the agents, and perhaps more fundamentally, the corporate contacts that we were gathering the information of via the agents. So I think there was a genuine uncertainty at that point as to what would be the impact in the UK labour market of the end of the furlough scheme.
Again, I would submit that just characterising this whole episode is one with the benefit of hindsight. There was actually contemporaneous evidence that, on balance, you chose to wait to see whether that followed through into, genuine wage pressures, and that's where the hindsight comes in. Yeah, as opposed to you did have contemporaneous evidence.
I know Silvana wants to come in, but can I just add one point? Because I just want to have a reflection of conversations that I do a lot of trips around the country with the agents, and recent conversations, actually. I was in Wales 3 weeks ago, and this conversation came up with a number of businesses, going back just to that point in time that you rightly referred to, and them saying to me what they didn't expect. And this goes to the inactivity story, was that was their labour force actually saying, I've reevaluated, my life, as it were, and I'm not going to come back to work. They're open in saying we just didn't expect that to happen.
Yeah.
And that's part of the inactivity story, of course.
Okay, I'll bring in Silvana and Jonathan, and we can talk about what this information informs us about your future outlook in a minute. Silvana.
Yeah, just to put the factors into perspective, the labour market contribution is very small. The dominant shock in 2022 was the war in Ukraine and increase in energy prices and other commodities, food prices, and that's important to keep in mind. At the 11% peak in inflation last year, 8 percentage points of that was contributed by energy and other goods prices, which are largely determined in global markets. These are mostly tradable components. The rest, the 3 percentage points, came from services, which is more affected by domestic input costs like wages and obviously more influenced by monetary policy. Now, if we just follow those numbers and take that 8 percentage point contribution from abroad, then to have inflation at the 2% target last year, given that services represent 2/5 of the CPI basket, would have necessitated inflation in the services sectors to be minus 15%. That is, to meet the 2% target in 2022, we would have needed a services deflation of 15%. Now, in practice, of course, the split that I gave you is not precise. You can refine it. Some good sectors include some non-tradable components, and monetary policy can affect good sectors' inflation through other channels. And conversely, services inflation contains some energy and food components in them. So this, but even if you refine my calculation, the conclusion is that you still need services inflation running at deeply negative, in deeply negative territory in order to meet the 2% target. Now, as you can imagine, having deflation of 15% in services requires a massive recession, much bigger than the great financial crisis, with unemployment at 2-digit levels. This is at the time in which the economy was trying to recover from the COVID shock. And let's not forget that consumption at the time and investment, even now actually, they're still well below their 2019 levels. So in my view, it would have been incompatible with our remit to have inflation at target last year. Now, I mentioned this 8 percentage point contribution. As we go forward to the next 2 years, 2 to 3 years, that 8 percentage point, as those prices stabilize or even turn negative, as we've been seeing, this will become 0 or negative. That means that the level of services inflation you will need to meet the target, again, with a contribution of services of roughly 2/5, would be 5%. That's the level of services inflation we will need in the coming years to meet the inflation target. So if you really want to hit target at all times, you need to go from -15 to 5, which is an impossible task for any central bank. I mean, you cannot switch unemployment from 2 digits.
I think what we're keen to ask you to do, and we appreciate that if you're going to get a massive spike in something like energy, then that will make it difficult to achieve 2% on a day-by-day basis. We accept that, but it is notable that the day before the invasion, inflation was already running at 6%, and that the base rate was at 0.5% on that day. Yeah.
What we learned, Harriet, from with hindsight, is that those restrictions in gas supply had started earlier, and that was not known to us. But as I said,
I think it was.
Yeah, that's what I'm saying. But we didn't. I mean, we could see the price effect, which was not, which was just the beginning of it, but we didn't know that this would be a sustained strategy by Putin going forward. So, I mean, you at the time could have seen it as a temporary.
But you mentioned services inflation, and in your latest report, you say that services inflation is at a new high. What I'm trying to press you on today is that the second order effects in terms of inflation have now become much more deeply embedded in our economy and will be that much harder to remove.
Let me talk about that. Yeah. So as I said, I mean, in order to meet the inflation target, we would need services inflation to come down from the current 6.8% to 5%. Is that feasible? It is, and this is what is in our forecast. There are 3 elements to that. First, services inflation does incorporate some energy and food components. Some services are very intensive in the use of those. And in fact, if you look at just services that are not energy intensive, inflation there has been less than 5%. So naturally, as energy prices come down, there will be a direct slowdown in services inflation. The second component is wage inflation, and we have already seen a slowdown in pay growth in the high-frequency measures. If you look at 1 month on 1 month or 3 month on 3 months, this has been falling since July. And then the last one, and this is, of course, the big one, is monetary policy. We have tightened policy significantly over the past year, and that's going to be to have a large impact on demand, hence the labor market, and this is going to be the transmission mechanism that will ultimately bring inflation. In fact, it's going below target in our forecast, well below target. And so those elements should give you the reassurance that we are more than on track.
I accept there are some year-on-year effects that are going to roll out. Where I'm somewhat probing you here is that whether a 5% level of inflation has not become quite ingrained and embedded as a second-order effect in the UK economy. Jonathan.
Yeah, thanks very much. Chair, I guess I don't want to move the conversation backwards, but I just want to say 2 things. One is, I think it's important if we go back to the issue around the furlough and the late 2021 discussion that we were just having. I think it's important to understand, as Silvana's just said, the context in which that was the case. You'll have seen chart 3.7 in our report on page 87 gives the level of investment over that period. And the level of investment was around 10 percentage points below the pre-Omicron level in that late 21 period. In other words, the economy was extremely subdued. And if you were to say, I want you to tighten monetary policy with an incredibly low level of investment, that would have that would not normally be a very good thing to do. That was one thing to do. And then the second thing, which also goes back to the issue, there was absolutely a lot of uncertainty around the furlough. But as Andrew just mentioned, we mustn't forget that Omicron was a major threat at that time as well. Could I just say a quick word about that? Because I think that is a case study in what we know now as opposed to what we knew then. We now know that the vaccine was robust against Omicron, but we didn't know that then. We took advice from Chris Whitty, the best advice in the land, about the situation in Omicron. And as you remember, when Omicron first came out, I think it was in South Africa, there was significant concern that it would indeed get past the vaccine. The vaccine would be ineffective against it. And I remember asking Chris Whitty, well, what happens then? And he told us the facts. And the facts are that a vaccine would have to be re-engineered. That would take 3 to 6 months. And we would have to start vaccinating everybody all over again. Now, again, we know now that did not come to pass. But if you'll forgive my just dwelling on it, I think it's a little study about how we didn't know back then, and we had to make policy with the benefit of what we knew at the time.
So
Sorry for that long.
Are you not concerned now
intervention.
that the second order inflationary effects have become much more embedded in the UK economy?
So I am concerned that they are, and that's why I'm voting to raise. But the point I'm trying to make is a slightly separate point, which is, with the benefit of with the information we had then, we didn't know that at the time. So we did the right policy decision at the time.
Okay. Anthony.
Thank you, Chair.
Can I do just one clarification? When I mentioned 5% services inflation, that's enough to meet the target because services is 2/5 of the basket. And the other side of the basket is going to
negative.
be, exactly.
Yeah, I understand that, yes, yeah. Anthony.
Thank you, Chair. I'm looking at the prospects of inflation over the coming year. At the bank, you declared that we've now turned the corner, and your projections are pretty much downhill all the way. I really want to get a range of views of what the risk is to that. I mean, is there a real risk that it won't end up going downhill the whole way? And then second question is, the government, as you touched on earlier, the government has given itself its own target for inflation to halve it by the end of the year. Do you think there's any risk to not meeting that? Because obviously your expectation is that it will meet that. I'm going to take a range of views, but I'll start with Jonathan and then go right.
Thanks very much.
So is there any risk to not going downhill the whole way this year?
No, thanks for the question. Anthony, well again, why don't we just refer to the report, since the hearing is about the report. So on page 27, we lay out this rather complicated table. So apologies, it's a complicated table. There's tons of information in it, which I think speaks to your issue. So as you say, our projection is that CPI inflation will go down from roughly 10 at the moment to around 4 at the end of the year. Of that, the energy price contribution is going to take about 3 3/4. So that's a fall of 6 3/4. The energy price, as I say, we publish it, in black and white in the report, is going to take 3 3/4 off that. We can have a reasonable amount of confidence about that because of the way that the Ofgem price cap works and our current knowledge of what the futures curve is. Now, of course, as Andrew was just saying, were there to be another significant shock, then that would imperil that. But we've got to do the best we can, again, given the information set we know. So of that fall of 6 3/4, as I say, about 3 3/4 is because of energy. There are indirect energy effects, as Silvana was just mentioning. Of course, energy has a direct effect because we buy gas and electricity, but then there are indirect effects because restaurants have got to consume energy and all that sort of stuff. Add maybe 0.25 to that. That's about 4 percentage points on that. So then that takes you from 10 to roughly about 6, and so the question is, where are the other 2 going to come from? And there, I think, we are being ever vigilant on that issue. That then gets one to the issue about what's going to happen in the labour market, what's going to happen to our export prices, and so on. So again, without going through all the various details in the report, all the numbers are there. I'll stop quoting the numbers. I think I would say that a lot of that energy effect is kind of locked in. Again, based on our modelling with the futures curve, and we're incredibly vigilant about making sure that the rest of it comes through. Does that help?
Yeah, no, absolutely. So, Silvana, what do you see as the main risk to inflation coming down to 4% next year?
Well, I mean, as
Apart
the
from
Governor
energy,
and Jonathan said, unless there is another big development that we don't know about, and we have a massive energy shock or something that it's not on the cards, then I think the fall in inflation is pretty much guaranteed. And this is again that mechanical effect that we were talking about. Those prices that went up incredibly high last year are coming down or stabilizing, and that turns that 8 percentage point contribution to 0 or negative, and then you can do the arithmetic of the rest.
There aren't other things that you're particularly worried about. I mean, it's unknown energy
given
price
the
shock,
amount of
which-
tightening that we've put in place, which
nothing can
will
knock
be,
it off course, basically.
pardon me?
Nothing else can really knock it off course then, apart from a big external shock.
Not something that we know at the moment, and that we possibly can know at the moment.
You know, you're in the latest meeting, you wanted interest rates to remain at 3.5%. I was wondering, do you think that the rates are at the wrong level now then, or have you changed your view?
Well, I mean, as for all of us, my decision is about how best we can meet the 2% target in the medium term, and in line with our remit. And of course, the reason why our remit focuses on the medium term and why we build forecasts is because there are lags in the transmission of monetary policy to the economy. It takes time for changes in bank rate to feed through.
So previous rate rises haven't fed through yet, and that's
we've seen very little of that feeding through. About 1/5 of that has come through. The rest is still to come. And so the impact of monetary policy combined with this energy and other commodity prices unwind should be more than enough to get us actually not at target but below target in the medium term. And this is why, in my view, yes, rates are too high right now, and that's why I didn't support the vote.
Andrew, same question. I mean, apart from another new energy price shock that we don't know about, what do you see as the other risks to inflation getting down to 4% next year? And is there any risk?
Just have to be clear, because our target is 2%.
Not your target, but the predicted 4%.
Yeah. So Silvana and John were saying, I think the base effects are, unless, as I say, something happens that we just don't know about. I mean, that would be something like some development in Ukraine that we just don't know about at the moment, which would obviously be tragic. Those base effects are sort of solidly built in because they're sort of arithmetic in many ways. I think, for me, and this was the big decision we had this time, you can reasonably, of course, as Silvana has described, ask the question, if you've got that forecast, why are you raising interest rates at this point? And we spent a lot of time discussing this very question. For me, there is still substantial remaining uncertainty, particularly about the domestic side of things, because we have had this other shock, which is the tightening of the domestic labour market, and particularly the rise in inactivity. Now, just to give a quick summary of what we're hearing and seeing at the moment on that front is that of course at the moment the numbers remain tight, and they're tighter than we thought they would be at this point in time, and particularly on the inactivity side. The agents are telling us at the moment that there are early signs, and certainly I pick this up when I see firms as well, of some signs of loosening. But that will come through more in a decline in vacancies and potentially in a decline in hours worked. It will not necessarily come through so much in a rise in unemployment. And the reason for that, and firms say this to me quite consistently, is that it is so hard to recruit people in the current environment, and has been, that they will be reluctant to shed people. And they're more thinking in terms of reducing hours rather than heads. That's, by the way, important for our forecast, because reducing hours has a different effect on people than losing jobs. It's a milder effect, and that does feed through into people's views on savings and on demand. Final thing I'd say on that is the survey evidence. I think Hugh was referring to this earlier, and one of the more prominent ones came out, was it yesterday or the day before, the so-called REC survey, and that's a leading indicator. So there's a lag before those sorts of surveys actually come to pass, as it were. That is pointing to, and has been pointing for some months now, to a loosening in the labour market and to a loosening in pay. For my part, though, why did I vote to raise rates? We need to see more evidence that this is happening. We have not yet seen evidence of this, and I am very cautious on that front. Well, as I said, I do think we've turned a corner in terms of headline inflation. It is not only fallen; it's now under what we thought it would be in the November report. But we need to see more evidence that this process will take effect.
You mentioned there the risk of a tight labour market.
Yeah.
What are the risks that inflationary pay rises in one sector, and I'm thinking particularly the public sector, because we're obviously in the middle of the toughest public sector pay round for a generation at least. What are the risks that if you had inflationary pay rises in the public sector, that would help fuel wider inflation?
Well, of course, I mean, most of what we talked about on the labour market is about the private sector, not the public sector, I should say, and that's where the pay evidence is coming from. There's quite a big wedge now between private sector pay settlements and public sector pay settlements. I think in terms of the debate on public sector pay and its impact on the economy, I will be careful what I say here, and I will just say one thing, and only one thing. In terms of, you think through to the demand effects, it does depend on how it's funded.
You mean whether the government borrows more? Or,
yes,
yeah.
In terms of what its overall effect is. Because there is, I know, quite a debate about what's the impact of public sector pay on the overall demand in the economy. Is it like private sector pay, or is it not?
What's your view on that?
So I'll be careful what I say here. I don't think you can say there's no effect. I really don't think you can say that. But I think it does depend.
What is the effect?
Well, it does depend on how it's funded, frankly.
I mean, if the government ends up having to borrow more, then it'll...
Look, I'm really careful here, because I'm not advocating anything at this point, because this is not territory the Bank of England would, of course, want to be in. In the economics of it, I think it depends whether you raise taxes or whether you borrow, frankly.
Yeah. But in terms of the actual public sector pay rise, are there concerns that if it is inflation across the board in the public sector, are there concerns that it will raise expectations of inflation across the board and sort of second order effects, or is it just that funding issue?
Well, I think it very much depends what form it would take. I mean, let's also remember that at the moment, all of these, I mean, when you talk about inflationary, all of these pay supplements, of course, are under the level of inflation. But I think you do obviously have to be forward-looking. We don't want to say, so you have to be forward-looking here. I mean, what I would urge is that when particularly going forwards, because we think inflation is going to fall very rapidly, that is taken into account.
I mean, you're right that obviously a lot of the pay offers at the moment are below inflation, but a lot of the pay demands are at inflation or above inflation. And if they are met, those pay demands, then is it just purely how it's funded? What could be the impact on inflation?
Well, I mean, the points I've made before, and I will make again on this point, is that because of the nature of the shocks that we've been having, and because they are predominantly external shocks, as colleagues have said, and this is coming through the terms of trade, I'm afraid, and I'll make it very clear, this applies to price setting as well as wage setting. It's very important to say that. If of course, there's a continual attempt to beat those shocks, then I'm afraid the chair's absolutely right. That's where the second round effects come from. Now, let's go. I mean, we've seen pay settlements, in particular in the private sector, are higher than consistent with the target. They're not at the level of inflation. And the question for us, as I said before, is, are we now beginning to see evidence of loosening in the labour market which will affect those pay settlements? And there is evidence to suggest that, but it's, in my view, too soon to conclude.
Well, the last question on this before I move on, but if the government did meet the inflation wage claims across the public sector and borrowed for it, because taxes are already at a 70-year high, you said there would be an impact. What would be the scale?
There would be a fiscal impact in that case, and that would then have to feed through into...
what would be the impact on inflation?
Well, it would effectively cause a stimulation for the fiscal effects, and we would have to take that into account. So yes, it would have an effect if you do that.
In terms of potentially higher interest rates than would otherwise be the case.
But I want to be very clear, because this is obviously a sensitive subject. I want to do no more than lay out the channels.
It's asking about the economics.
No, I know you are.
Not the politics.
It's a fair question.
It's one of the things the government has to think about.
No, it's a totally fair question. But this is a very sensitive subject, so I will merely lay out the channels. I'm not going to advocate any particular policy here or there.
No, I get that. But obviously that's one of the factors the government has to think about when it's in the middle of these negotiations. Yeah. Can I ask about, so actually I'm going to come to Hugh. Sorry, you haven't had a chance to, and then I've got some other questions. So Hugh, my sort of initial question of what do you see as the main risks of, you've got this forecast of going down to 4% by the end of the year, and apart from some new developments in the energy markets in Ukraine, what do you see as the main risk to that? And do you think the government is pretty much guaranteed to meet its own target of halving inflation by the end of the year?
Well, I mean, I'm on the end, so a lot has been said, so I'll try not to totally echo. I mean, I think it is, so I'll try and pick out my key points. So I just wanted to echo something the chair said right at the beginning, and a little bit Andrew picked up on. I mean, I think it is important to see inflation is too high, and that has consequences for households and so forth, which is exactly why we are committed to get inflation back to target. And having inflation go to 5% or stop rising, etc., is not the same as getting it back to target. Our target's 2%, and we need to get back not just inflation to there at one moment in time, but on a sustainable basis through time. And that's the focus of our ambition and our actions, and hopefully what we achieve. In terms of the forecast, and as has been said by others, inflation is forecast to fall, and is forecast to fall quite rapidly. The reason it's forecast to fall is the mirrored image of why it rose last year. So we had the big rises in energy prices driven by external developments, which entered into CPI inflation. And those big rises will now fall out of the annual calculation. Yeah. In some cases, they will be replaced by still rises, just smaller rises, but nonetheless, that will result in a fall in annual inflation, and that's what we're looking at. What are the threats to that? Well, I think it is important to recognize that if we get big shocks, and those big shocks might be energy price shocks, but potentially they could be other shocks too, that could have an impact on inflation. But the character of shocks is that they are uncertain. And this is, just to hark back briefly to what we discussed. When I joined the bank kind of halfway through the process that we were discussing in response to the previous set of questions, I mean, when I joined the bank, I had a briefing on where we stand. I had a briefing on geopolitical developments, and the Russia-Ukraine situation was mentioned, but it wasn't in the top 5, right? So it really was a shock what happened. I think Silvana emphasized that addressing that shock would have required big developments in the UK economy. I think it's also important to keep in mind that given the lags in transmission, in order to have that impact, you would have to have known before the shock happened to avoid the volatility in price developments. And because it was a genuine shock, in the sense we didn't have the 1 year to 18 months pre-warning, monetary policy was not really in a position to prevent the volatility we've seen. And that's why inflation went up a lot. But it's also why inflation will come down a lot owing to these base effects. Very high level, I think, in order to address inflationary dynamics in the economy, and I would agree that because of other developments, including those in the labour market we've just been discussing, we have some domestic dynamic in inflation. We have done quite a lot to address that. We've raised bank rate by almost 400 basis points. We've gone from a situation where we were doing QE to now we're doing QT. The communication around monetary policy has changed very much since I joined the bank in September 2021. So all of those things have had their influence on market rates, including market rates at the sort of 2 to 3 year horizon that have a big impact on mortgage rates, and that is a big channel of transmission of monetary policy into the economy, and that's something I think we'll return to, I would imagine, this morning. And I very much agree with what Silvana said about this policy in the pipeline. Because of what we have done and because of the lags that I've emphasized, there is still more effect of this policy to come through into the UK economy. And I think it is important to see that those transmission lags are famously long and variable. And crucially, I think, they are also not entirely predictable. And so I would caution against the idea we can fine-tune developments in the UK economy. So, when we talk about inflation going to 4%, we have the famous sort of rivers of blood chart of inflation, and that reveals the uncertainties. Some of that uncertainty is associated with the possibility of further shocks, but some is uncertainties about how what we do transmits into the economy. And there is an irreducibility of how that works, irreducible uncertainty there, I think. And just again, to hark back briefly, is I think that does also caution about too much focus on, is it September, November, December, because the reality is we don't have that close control of the economy. So to me, the sort of message of the autumn of 2021 was, when I joined the bank, and this was not because I joined the bank, there was an inflection point in the conduction of monetary policy. And we went from a mode of being supportive in the face of the pandemic to being a mode of tightening in face of inflationary pressures. And I think that's the big story, and the big story was right. And I think that will contain inflation on this sustainable basis over the medium term, and that's the important thing. I think trying to expect perfection on a month-to-month basis is just to expect too much of monetary policymakers. And I understand from where you sit, I understand from where you sit that you should hold us to a high degree. We are accountable to you, and looking to perfection from us is not an unreasonable thing to do. I can only speak for myself, but I think I can speak to some extent for others. Of course, we strive for perfection, but we will fall short. But at the same time, I think it's about getting the big questions right. And I feel very confident, in line with things that Jonathan has said, that we did get the big questions right at the end of 2021 and into 2022 by tightening monetary policy, and then in the face of the energy price shock, accelerating the degree of tightening. So having said all that, I mean, to me, the challenge now is we have done a lot. There's still more to come through from what we have done. We have to be prepared to see it through. And I think, in terms of impact on the economy, we will have challenges. We'll have political challenges, we'll have economic challenges, but seeing it through is the key element of where we are. It's crucial to see it through, that we do enough to address potential upside risks to inflation. So I would agree with various things that have been said, but if you ask me what is the danger to the 4% or the danger to going to 2%, it is seeing greater persistence inflationary dynamics associated with stronger pricing power on the corporate side in the UK economy, so supply chain disruptions and so forth and so on, and or stronger wage and cost developments in the labour market, owing to the unexpected and continued tightness of the labour market, which we've done a lot of work on. We think, in line with what Andrew has said, is beginning to change, but nonetheless there are deep structural issues, what's going on in the labour market, that are not fully understood, and we need to understand better. So I think that is where the issue is. I think we need to guard against doing too much with policy, because there is a danger of oversteering if there are lags in transmission. But at least where I stand now, the sort of right stance, which is, I think, more similar with what Andrew and Jonathan have said, is that I think we should be watchful to these risks of greater persistence. That points to me to looking at developments in price-setting behaviour in the corporate sector and wage and cost-setting behaviour and tightness in the labour market, and how that feeds through into services price inflation and so forth. I think we've been pretty clear in our communications. That's where our focus is. And should we see things there that cause us to worry, and in particular, I think what you can miss in these discussions is, very understandably, we tend to address these questions like shock by shock. What's the impact of the labour market tightness? What's the impact of higher energy prices? What's the impact of the supply chain disruptions? I think what we have to do, and where the forecast helps us in our discussions, is take notice of how these things interact with each other. So it's the combination back at the turn of 2021 of that period of supply chain disruption with unexpected tightness in the labour market that I think led to greater persistence than we would have liked to see. Yeah. And again, it's in the course of last year, it's the combination of that tightness in the labour market with the impact of the energy price shock. Yeah. And looking forward, I think if you ask me to say what's the biggest risk I think would be that it's that interaction with a continued unexpected tightness in the UK labour market with some external inflationary shock, rather than one or the other in isolation, that I would be most concerned with.
Can I just ask you the question I asked Andrew, sorry about that, you talked about wage setting there. As Chief Economist of the Bank of England, if the government did give pay rises across the public sector that were close to inflation, or met that, what would be the impact on future inflation and interest rates?
I think you're asking me to give a different answer to the government. No. I'm just teasing by that.
I'm sure you'll agree with him. You might expound a bit more.
I think to give the answer I want to give to that, I'm going to have to give you a slightly broader context. So you're going to have to be patient with me, right? So I promise not to run time down through this way. So again, if we look at what happened last year, what is the big shock to the UK economy? Well, as others have said, the big shock, it was unexpected, as I've said, is the rise in gas prices. And that wasn't just unexpected, it was a massive shock. You know, when I joined the bank, the gas price was 75 pence per therm. If you look in Table 1B, the average pre-COVID is running at about 50 pence per therm. At its peak on August bank holiday last year, it's 880 pence per therm. So it went up more than 11 times. Much more than Sorry?
Are you going to answer my question?
No, I am, but this is very important to set the context, right? So there is this unexpected, massive shock, and because the UK is a net importer of natural gas, and we are quite reliant. So we are quite reliant on natural gas for heating and electricity generation. This represents a very significant adverse terms of trade shock. So, you know, I've said this in this room before, but simply put, the price of what we're buying from the rest of the world has gone up a lot relative to the price of what we're selling to the rest of the world. So for UK residents, that implies a big squeeze on income.
Yeah, absolutely.
Right. So the question at hand is whose real spending power, and it's income in real terms, real spending power. So who is going to take that cost? How is that distributed across public sector workers, across private sector workers, via government transfers to future taxpayers rather than current taxpayers, or to people who rely on profits for their income rather than people who rely on wages for their income? So I don't think it's for the Bank of England to have a judgment about these distributional questions. We don't have a mandate for that.
I wasn't asking that.
No. But the point I want to make, so that was all preamble to get to the punchline, which is the answer to your question. So I apologize. I did warn you it was going to take a while, but now we get to the punchline to your question. The punchline to the question is the way I see it is, the more intense that distributional battle, right? So there is a certain size of a pie. It's a smaller pie than people have liked. Everybody tries to retain their real spending power by asking for a bigger share of a smaller pie. It's the irreconcilability of everybody asking for that bigger share that is what drives inflation.
Poor as a country.
Right.
Yeah.
And so the implication of what you're saying is, if, you know, whether it's wage bargaining behavior or price setting behavior or the actions of public sector workers versus private sector workers, these are all parts of the intensity of that. What all we can do, and what we should do and will do, is ensure that we respond with monetary policy to make sure that the intensity of that distributional question does not spill over into inflation. And so if your point is, if things we see or lead to greater intensity in that distribution battle, as Andrew said, that implies that monetary policy will be tighter in order to keep aggregate behavior in the economy in line with price stability.
Just to be explicit in that, if my precise question was on if the public sector wage agreements are of inflation or around inflation, that will, what you're saying, I'm just trying to unpack what you're saying, is that would have some impact on future inflation
it's
and interest rates.
So, I mean, there is certainly the potential for that to happen. And if that happens, our job is to ensure it does not lead to inflation by responding to it with tighter monetary policy.
Okay, thank you. I've got questions about the bonus cap and everything else. Should I do that now or later?
We'll come back after to do that. We'll just stick with the monetary policy thread for now. And I just wondered, Hugh, if you could quantify for us that, because you were forecasting 13.1% inflation peak at one point, and the peak I think was 10.7. Is that difference the energy price cap on households and businesses, or is it something else?
I mean, it largely is. So if you look back, I think you're referring to the August report. So in the August report, if you remember at that time, partly because of the political situation in the UK, we did not have a fiscal response to the very dramatic rise in European wholesale gas.
September.
And at the time we made the report, which was based on, we make an assumption about how what wholesale gas prices would be based on market pricing. Yeah. So the window we were looking at for the August report was basically a 2-week period towards the end of July. in that period, that would lead, and it was at that point quite a mechanical calculation, because it's about futures prices feeding into the Ofgem price cap and so forth, and that Ofgem price cap, how it applies to the average household, how much energy they spend in their utility bill, that is what enters the CPI inflation calculation. So there's a fairly mechanical dynamic that led to that. I mean, unfortunately, and this is what we discussed in this room in September, was it's mechanical and obvious to everybody. So during August, wholesale gas prices doubled again. And lots of investment banks made the same calculation. And if you remember, there was this discussion of, is their forecast for inflation, which are actually substantially higher than 13%, were they legitimate or not? But through this mechanism, they were entitled. But of course, once we had the new Prime Minister, we had the energy price guarantee and so forth, and that shifted from what could have been on the Ofgem measure of average household energy bill, potentially approaching £6,000 a year, down to about, £2,500 a year.
You think the difference between the 13.1 and the 10.7 is by and large explained by the energy price cap?
Yeah, I think a big part of it
Okay.
is.
All right, Danny.
Thank you, Chair. Great. We've got a bunch of questions, so appreciate fairly snappy answers. I mean, at your discretion, but don't need too much context. And in fact, this one, I'd really appreciate some clarity. Governor, if I may start with you with a really straightforward question. You've said the report is now saying that we think that we've turned the corner on inflation. That's the headline message, I think, from the report. But at the same time, you're raising rates.
Yes.
And you're doing so before the full effect of the last rate rises has been properly felt. So can you just explain for the public what the message you're hoping they should take about your assessment of inflation at this time?
I'm happy to do that, because this was, as I said earlier, this is a very big subject of conversation in the round we've just had. So I do believe that inflation has just turned a corner, and the reason for that is that the last 2 months we've seen a lower number, but it is also, as I said a few moments ago, below where we thought it would be. It's a bit below where we thought it would be in the November report. Second, and probably much more significant, is, as we've said, these very strong negative base effects that will other things equal bring it down quite substantially. More so in the second half of the year than the first half of the year, by the way, in terms of the slope, that is, but they will bring it down. However, as we've discussed quite a bit already this morning, there is substantial uncertainty, not around the base effects. I mean, we've since covered that off, I think, by saying it would take something we don't know about to, in a sense, counteract those. But just where the labour market is going and just where price setting is going in the economy. Now, the agents, as I said, are telling us they do see signs now that it is turning. But my view is that we are at a point where the uncertainty is such that, and the risks are therefore such, but bear in mind in the chart that he was referring to, the so-called fan chart, we have got the largest upside risk on inflation that we've ever had in the life of the MPC, which is over 25 years now. And the reason for that is that there are a number of stories you can tell that create that risk. One is obviously labour market pressures. Two would be if energy prices do not keep coming down as the futures curve of markets suggests that they will. And we did actually put a number in there, so because we used to use a different approach, which was to take the first 6 months of the futures curve and then just pin it basically at a constant level. If you impose that onto the forecast we've got now, you add about 0.8% onto inflation. So you can see there's upside risks. But particularly with the labour market, and speaking for myself in terms of my own vote in this last round, I want to see more evidence that we've turned a corner, but that we really are going to go on now. And particularly, it's not just what happens this year. In fact, it's not primarily. It's that we do sustain it thereafter.
Yeah.
Okay. So to summarise for me, your assumption is that that inflation is now falling, but in order to make sure, you need to keep the lid on demand a little longer.
Yes, and that we need to see where the labour market and price setting is going to.
Okay, thank you. It's very difficult communication. I do appreciate you're trying to basically put the foot on the acceleration and the brake almost at the same time. You want to encourage confidence, but also not have too much exuberance in the system. So it's difficult communication. It reminds me slightly of the Archbishop of Canterbury trying to have it both ways.
He's got a divine intervention on his side.
Well, you too.
That.
So do you. So do you. So can I, given the challenge of the communication, I'm going to slightly sort of attack you all from both sides, if I may.
Go on.
On the inflation predictions, so we've discussed this a bit already, but the predictions for services inflation still is in fact higher than you were thinking it was going to be last time round. So, and that is largely driven by wages. And I know you've discussed this with Anthony, but just you famously said, Governor, some time ago that you discouraged people from seeking pay rises.
No,
do you feel vindicated by that warning, and do you want to repeat
clear.
it?
I mean, that was in the context of excessive pay rises that seek to beat inflation. And it's Hugh's point about the cake or the pie, as he said. We know why it would be natural to do that, but as I think Anthony interjected a few minutes ago, unfortunately, the nature of these shocks, these terms of trade shocks, is that the country is worse off as a whole. And it's that process. But no, I'm not. I don't want to sound. No, I'm not going to say I'm vindicated. It is a very difficult situation for people in this country, and particularly for those on low incomes.
Well, let me come at it from the other side, perhaps then, and talk about people who are working hard on low incomes, which are people in the construction sector. So this is a leading indicator, as I understand it. Often you can see what's happening in the economy a little further ahead if you look at what's going on in construction. Jobs in that sector are falling. I mean, there's increasing vacancies in construction. Mortgage demand is very low. We're putting up rates again. How much rate rises, how much interest rate increases do you think the housing market can bear? At what point would you start to worry about the effect on the housing market from these rate rises?
Well, we do follow it very, very carefully. What I would say is that, particularly in terms of new fixed-rate mortgages, which is of course fixed rates are now the predominant mortgage type in this country, rates have gone up clearly, as I think we were saying earlier, and Silvana was saying it earlier, because obviously we've put rates up actually over the last, since November, and I think since we had the hearing in November, when I did say I hoped that mortgage rates would come down. They have. So, not untypical, about 1% actually have come down, and the reason for that, of course, is that these fixed rate mortgages are priced off the interest rate curve. They're priced off the swap curve actually, and we have seen since the sort of the obviously period of difficulty in September and October, the curve as a whole has come down, and that's been reflected through into mortgage pricing. So that is helpful, I think.
Yes, well, demand is coming down too.
Well, I think yes, but can we? Those are slightly backward-looking indicators. I think again, the effects of last autumn affected also activity in the housing market, because, as you may remember, a lot of mortgage products got withdrawn from the market. They're coming back onto the market now, so we'll see.
Yes. Okay. Thank you, Hugh. Can I ask you about the future and the sort of scenario we might find ourselves in? And I appreciate we're not totally clear whether we're going to be in a recession or not. Very much hope not, but some significant risk of it. If we were, I mean, recessions usually involve very low inflation. Even if we hit the targets that we're hoping for here, we're still going to be at 5% inflation and potentially in a recession. The combination of that is terrible, and it does take us back to the 1970s. If wages are falling as well, prices are rising, that is absolutely catastrophic for living standards. How much do you worry? Well, I'm sure you worry a lot, but to what extent do you foresee a sort of stagflationary or inflationary recession?
So, of course, we're very concerned about that. I hesitate, because I know you've asked for short answers, but I just want to put it in context. I mean, what we can do with monetary policy is essentially steer spending in the economy, demand in the economy, including through the channel you mentioned, through the housing market, but also other channels. And we want to steer demand and spending in the economy such that we don't generate too much demand relative to the productive potential of the economy to generate either more inflation or more persistence in inflation. But equally, there are risks on the other side. If we slow spending down too much by raising interest rates and so forth, then too weak demand relative to the production potential of the economy will obviously lead to downward pressures on prices and ultimately disinflationary forces that push us below target. So to meet the inflation target sustainably, what we're trying to do is sort of map, given the inflation rate, steering of demand, given the production potential of the economy. So I do think it's important to see, and of course this edition of the Monetary Policy Report contains a big section looking at the supply side of the UK economy. It is important to see that the supply side of the UK economy in our forecast is weak, and that is a constraint on our ability to let demand run. Now, to a first approximation, I think to say this is black and white, I think we would take it too far, but to a first approximation, monetary policy does not have that much effect on the supply side of the economy. And we can talk, and maybe you want to talk about why we take the view that the supply side of the economy remains very weak. And I think that's important to put this notion of, recession and so forth in context. So we have a very shallow recession by the historical standards of recessions. It's still a recession in our forecast, meaning on the definition that's typically used, a technical recession of at least 2 quarters of negative growth. But we are kind of bobbling around zero, right? So in fact, the fourth quarter, which we thought would be a negative number, may turn out to be a zero or positive number, and then the second half of last year may not be a technical recession. Once we're bobbling around the zero sort of level, for exactly the reasons we talked about earlier, given the uncertainties we face, including the uncertainties about how our policy transmits, we may see weak positive growth, we may see recessions, we may see negative growth. So the point is, I would a little bit get away from focusing on recessions. But I think we will see a relatively long period of weak growth. And the fundamental driver of that is weakness on the supply side.
Well, we do want to come on to the supply side in a bit, if you don't mind. But I mean, that might be true that the recession will be weaker overall, and seeing from the bird's eye perspective. But actually, for particular sectors of the population, it's going to be very acute. Perhaps in fact, that's a difference between recessions historically, that it'll be far worse for some people that it wouldn't have formerly. And I think I mentioned particular people working in construction, but if we're talking about wage deflation in some areas and these price rises, it's going to be absolutely catastrophic for a good. I mean, I think the NISCR saying this week they're expecting a quarter of households to be unable to cover food and energy.
I certainly don't want to push back against the cost of this environment. It goes very much to what our chair said in her opening, I think, first sentence almost is, inflation has been too high. It may have been driven by external sources and we're trying to correct it. But this terms of trade shock has very big implications and very challenging implications for a set of businesses in some sectors rather than others, in some parts of the country rather than others, and sets of households, particularly those towards the bottom end of the income distribution who spend more on energy and food. So we are very aware of that. I think it's also important, though, to recognize that monetary policy, as sort of we've been discussing, is potentially a very powerful tool to steer aggregate behavior in the economy, but it's also a very blunt tool, and it's just not well designed to try and have impacts on one sector or the other. And we don't have a mandate to do that as the MPC. Of course, we need to monitor that, because how our policy transmits into the aggregate is importantly affected by these distributional effects. So we do look at cross-sectional, cross-regional, cross-income distribution impact of our policies very closely, and that's something we monitor. But I think we have to be cautious about taking responsibility for something that, frankly, we don't have the instruments to address.
I appreciate you are very powerful but very blunt levers at your disposal. Okay, thank you very much, Hugh. Professor Tenreyo, can I come to you? You're the leading dove on the committee, so I understand it on interest rates. Is it possible to ask you to tell us now what your advice will be in 3 months' time? But at the moment, do you expect to be calling for a cut in rates, seeing as you didn't support the raise that we've just seen when it comes to the next meeting? And I suppose a fairer way of asking that is, what will you be looking for the advice that if we were to expect you, if we were to see you calling for a cut, what would you be looking for in advance of that, and what would you expect your colleagues to be convinced by that would make them support you in a rate cut?
Well, I think I made my points clear that I think policy is already too tight to meet the target. In our forecast, we have our modal projections for inflation fall well below the target. The mean projection, mean inflation, also falls below the target. So that means that the risk to the downside of that 2% is higher in those projections than the risk to the upside. As I said before, how can we loosen policy? One is directly through cutting rates or through an inversion in the curve, and that can happen on its own even without our actions. But definitely, I where things stand right now, I would see myself considering a cut. I don't want to talk about a particular meeting because meeting to meeting doesn't make much of a difference. But the overall stance of policy right now is loose in my view. There are, of course, as the governor said, upside risks. Energy prices can go up, but also, as we saw, they can go down. They're still much higher than they were pre-COVID. So there's always that possibility too. In this round, we made a judgment to push up demand and hence inflation, and there are also risks to that on the downside. So yeah, I have a more balanced view of the risks at this stage, certainly around hitting the 2% target in the medium term.
Okay. Well, thank you. I mean, I'm going to come on in a moment to energy costs, if that's okay. But Professor Haskell, can I put Professor Tenreira's point to you? If inflation falls very fast, you'll end up below target, and then you'll be having to unwind these rate rises very fast. What danger do you foresee if that were to happen? Are you worried about having to cut rates very fast, and what the effect of that might be?
Yeah, thanks. Could I just step back for a moment, if you forgive me? I know you wanted crisp answers,
that's right.
But if you'll forgive me. I mean, we've talked a lot about uncertainty, and so you might say, well, what do we do in the face of uncertainty? Do we just sort of throw up our hands and just say it's all too difficult? And in my opinion, we should not do that. We should do two things at least. One is we should guard very vigilantly against really bad outcomes. And one really bad outcome would be a lot of inflationary momentum in the economy, as we've just discussed. The other bad outcome, to your question, would be if we undershot the target very severely. So that's kind of rule number one. Rule number two, which I think follows from that, is because of these risks and these uncertainties, we should be super vigilant on the signals that we are getting as they come along, so we can learn something about the risks and therefore better inform our judgment. And the reason I sort of say all of that is, what then am I doing? I'm very worried about excessive momentum building up for inflation, and therefore I want to guard against that, number one. And number two is, I am putting a bit less weight than I would otherwise do on the medium-term forecast. And I'm looking much more at the shorter-term indicators, to which you might say, well, what shorter-term indicators? And in speeches, I've tried to go through a number of those. The ratio of vacancies to unemployment, for example, is I think, an important, somewhat leading indicator, because putting out a vacancy means a firm is indicating in their future expectations of high demand, so I'll be looking at that. The redundancy numbers, again, because many companies have to notify the government if they intend to make redundancies under certain circumstances, big amounts of redundancies. Those are, I think, a kind of an interesting, almost accidental kind of leading indicator. Those are very low at the moment. The VU ratio is very high. And more broadly, the indices of inactivity, which the governor has sort of talked about before. So all that is to say, I am super worried about going under the target. But as I say, given the uncertainties at the moment, I'd rather put a little bit less weight on that medium-term forecast and look for those shorter-run indicators. I hope that's helpful.
Yeah.
Can I very briefly make one other point? We will, of course, if we get this outcome of inflation falling rapidly, we do have to stabilise inflation at the target. I just want to emphasise that point, because we could see it go under target just as we've seen it go over target, because base effects by definition don't recur in the same way.
Yes.
So that will have to be, of course, a critical focus for us.
Okay. Thank you. Shall I move on to energy
Go
cost
for it,
now.
Danny.
Brilliant.
Yeah.
Okay, next topic. All very related. So, I mean, when you came before us, I think it was in November, Governor, I asked you the impossible question about how you could have such confidence that inflation was going to fall when it was all in Mr. Putin's hands. It remains in Putin's hands, you know, to a significant degree. And I think you said in the media last week that as long as Russia continues this barbaric war, there's always the possibility that energy prices could go up again.
Yes.
Can you just tell us sort of precisely how you factored that risk into your work? I mean, it's an impossible question to answer, but it doesn't appear that this war is going to end imminently.
No.
And there is always the chance of further decisions or events choking off supply even further. How have you factored that into your...
Well, this comes back, of course, to what a number of us have said in the course of this discussion, that, you know, of course, we can't deal with something that's totally unpredictable in that sense, and we've had to come to that. What we have done, I'll just make 2 points, actually. First thing, and I'll go back to something I said a few minutes ago, and is in the report, which is we have done we've conditioned the forecast on what we call the full futures curve, i.e. the full duration of the futures curve. Now, that's a change of methodology, actually, from what we were doing in the past, but partly because, actually, the old method, as I said, was we used the first 6 months of the futures curve, then we took a constant price thereafter. The problem we ran into, was it last year? Yeah, was that particularly when going back to the summer, we would have had a very strange pattern to energy price inflation if we'd done that, actually, because of not least because of the way the sports scheme worked, and not a criticism of it. But as I said, we have done the what if. The staff did the what if we actually had the other, not the full futures curve. They don't keep coming down, but they stick it in the way we used to do it. And as I said earlier, staff estimate that would add about 0.8% to inflation. Now, you know, that's part of our consideration in the upside risk. We don't build the upside risk up bottom up. We do it rather top down, but then we have stories that sit underneath it, and that's part of it.
Okay,
great. Can I just make one other point? I just wanted to make a point that came out of something Hugh was saying. It's relevant to the energy point. And it's relevant to this point about low-income households. It's important to know, because Hugh gave the price of 50p a firm as the sort of pretty stable price pre all the Ukrainian things starting. This big downshift in energy prices, inflation, does not take the level of household energy prices back to that level.
Okay.
And of course, for the cost of living, that's that's relevant.
Yeah. Okay.
So I just want to...
Wait, no, point taken. I want to come back to some of your points, but Professor, do you want to come in?
Yeah, if forgive me, just add a little bit to what Andrew said. Being an economics professor, of course, I've got to talk about supply and demand. So you'll have seen in the report, we look at the demand for energy and see whether that has changed. And would that affect the outlook? And in chart 2.14, there is somewhat of an indication that people's demand for energy might have gone down. That's one thing, if I may. The second thing, if I may, is, as you'll know, what's crucial in the energy market is that we build up very high inventories of gas, which we then run down later, to come into the winter. So we monitor those inventories very closely as well to help us give a forward-looking picture about what prices might be.
Understood.
Thank you very much.
Just to complement that, they are at the storage levels that are up at 80% or so in the middle of the winter. So this is a very high level to start.
They're right at the top of the 2017 to 22 range, indeed. Yeah.
And more generally, there is a substitution to alternative suppliers and sources of energy, which has also eased the pressure and could be a source of downside risk as well.
Yes. Okay. Well, but we applaud demand reduction in energy. So that is.
To be said, that has been huge in continental Europe. In this country, I think there is more to be done.
More to be done. Great. Well, we should think about policies on that. I think wearing three-piece suits is a very helpful way to reduce demand for energy, and I encourage it for all members of the committee. Governor, you talked about the futures market, which is in a sense that seems to be the sort of the god of this of this bit of policy making. When we had the ABR in, we said to them, what are you basing your predictions on? Well, I think we asked the Chancellor, and he said the ABR says that inflation is coming down. we said to the OBR, why is inflation coming down? He said, because the energy futures market says it is. They're very, very bullish about reductions in energy costs. Why do you think that is? I mean, the war isn't ending anytime soon. Is there more LNG going to kind of come out of the nowhere? Why do you think the futures market is so confident?
Well, of course, energy prices, first of all, I mean, since we had the hearing in November, wholesale gas prices have come down a lot. It's 50%. I mean, I have to, again, we have to sort of, be clear on the limits of our knowledge. That's not something we predicted when we were here in November. Yes. I think looking forwards, I would say there's a balance of factors in the market, and I think some of them point one way and some the other way, frankly. I think, Europe has built up its capacity to receive particularly liquefied natural gas from other parts of the world, and that has helped, particularly with what Silvana and Jonathan were talking about, the storage position. That has helped a lot. I think my assessment would be, I don't think currently there is a large increase in global investment in more gas extraction and oil extraction. So that has obviously will have an effect in terms of available supply. I mean, there's a very interesting question, obviously, about how the Chinese economy is going to recover and come out of the COVID restrictions, and what that will do to China's demand for energy, because China's obviously a major importer. And of course, the third factor is Russia. Obviously, parts of the world that are implementing sanctions have reduced their dependence on Russian supplies. The question is, there are other parts of the world, don't put it that way.
Yes. First, I want to come to you, but can I just ask you in your question to answer this as well, which is to say, I mean, if we are going to have persistently high energy costs, and they might not be as high as now, but still, I think it's fair to say we're going to have high energy prices for some time. Does that automatically mean persistently high interest rates, in your view?
Let me answer. The reason I wanted to come was on the bullish point, if I may. So just if I can say, in chart 2.3, we do indeed show what you would imagine be a very bullish diagram, which is that futures energy prices, which I think you're referring to, do dive right down. But they dive right down to a level, the axis of the chart starts in January 2022. And I think, as Hugh said earlier on, there was, of course, a big run-up in gas prices in advance to the war. So although that chart looks like energy prices are going to drop back down to where they were, they're still well above.
Point I made about levels.
I'm sorry, yes, indeed, Andrew, They're still very well above, what they were immediately before that. So I wouldn't, if I may, I wouldn't be too bullish on the basis of that chart, if you sort of see what I mean. We still end up at that.
Well, indeed, yes. Overall, we keep being optimistic about a fall from a very high rate on all these things back down to a rate which is still not comfortable. And do you think, Professor, the other professor, do you think that those high prices are going to just lead automatically to high rates as a persistent feature?
No, not necessarily. Look, it depends how the economy adjusts. This is a high level of prices, which, as we've discussed, is very painful for people, and I don't want to minimise that. But as far as inflation is concerned, it's perfectly consistent to have a high level of prices, and it be consistent with falling inflation, with constant inflation. So not necessarily, no.
Thank you.
That's precisely the point I was going to make. There's a distinction between the levels and the change, and here even if we remain with very high levels of energy prices, the contribution they make to inflation, if they stay at those high levels, is zero. I mean, as long as they don't keep increasing. So that's the distinction. Now, we are still poorer. The country is poorer, and I think that's an important consideration too when we look at other countries that are net exporters of energy. Actually, this has been a big boost to their terms of trade, and we see that reflected in the differences across countries in real incomes and real consumption. In our case, consumption is still way below 2019 levels. If you look at the US, for example, which is a net exporter of energy, consumption has been running above their pre-COVID trends. So, it's a divergent picture, much more different. So,
that's very helpful. Thank you. I'm going to ask the Chair, how are we doing for time? I've got more questions, but I'm conscious of others wanting to get in, and we want to move on to other topics.
Yeah.
What do you think?
I think I'm going, because I know Anthony wanted to
11:50.
ask a few
Yeah.
things on the labour market,
Okay.
and then I'll
Come back to
bring that, and then I don't want to leave without asking about quantitative tightening and easing either. Yeah.
Actually, I was going to ask about bonus cap. So this is not Monetary Policy Committee, but obviously Andrew
Well, I
Bailey
can
as
pass it to
governor.
others, but yeah, I think it probably comes my
Issue
way. Yeah.
as the
all-rounder.
top banking supervisor.
Right.
So one of the survivals of the Liz Truss premiership is the commitment by the government to scrap the so-called bonus cap, and that was supposedly introduced. Obviously, the UK government at the time didn't support it, but that was supposedly introduced to stop excessive risk-taking in the banking industry. Do you have any concerns about getting rid of it in terms of that will lead to more risky behaviour?
I mean, I'm ancient enough to have appeared before this committee about a decade ago on this subject.
When you were chief executive of the PRA,
when I
think.
when I was briefly at the FSA and said that I didn't agree with the bonus cap when it was being introduced as part of European EU legislation. And one of the things I remember saying at the time, sorry, this sounds terribly prescient of me, and I don't want to sound like that, but that I was concerned that it would lead to two things. One is that it would lead to an increase in permanent pay, a substitution from bonus to permanent pay, and two, that it would lead, it didn't have the right incentives in terms of risk-taking. I think the first of those, and we've published evidence to suggest that the first of those actually has happened. On the question of why do we support getting rid of it? Well, first of all, it doesn't have the right incentives. It has led to that. Secondly, as you know, I think we've always had a UK policy framework in place, which remains in place, which has a different sort of thrust to it, and I think is consistent with the right incentives, which is that it involves several things, but one is deferral
and clawback
of the payment out of a quite a good proportion of the variable remuneration, and the potential then for what's called malice, although I often get transcripts back saying it's malice, and we don't have a policy of malice, I would say, but malice, which is taking it back before it's actually given out, as it were, and clawback even, which of course goes beyond that point. The other thing is that we have a policy of saying that we want a large part of the variable remuneration paid in instruments which are then subsequently reflect risk, not cash, in other words. So we think our view is that we've got a better policy framework in place, and the bonus cap has the wrong incentives attached to it.
So getting rid of it won't lead to more risky behaviour?
No, we don't think so, no. And that's why, I felt when obviously it was advocated by the government, my view was, look, we've taken a very consistent line on this. So, our view is very clear on it, I think.
Another change that's happening is to the ring fencing regime, and after the Skiok review has recommended various reforms to it, and we did have some questions here of the bank CEOs earlier this week, wasn't it, just a couple of days ago. Do you have any concerns about the changes to the ring fencing regime? Do you think there's any risk?
No, I think the proposals that Keith Skiok and his group proposed are sensible. I think my whole approach on these sort of areas of policy is that they don't remain, they shouldn't remain fixed for all time. Actually, they'll become dangerously not consistent if they do. So I think the things that Keith has proposed are sensible. I would also say, I know there's been some debate about the relationship between the ring fence regime and the resolution regime.
Yeah, I was going to ask that.
I see them as complements. They're not substitutes. They're complements.
Right. So the fact that we've now got a better recovery regime, we don't totally know how it would work in a real crisis, but that's not an argument for getting rid of it.
I think ring fencing makes would make the execution of a resolution and recovery more straightforward in that sense.
My final question on the as the prudential regulator is on the Basel 3.1 measures, which I think being consulted on at the moment, that will increase the capital requirements for lending to SMEs and UK companies with no formal credit rating and infrastructure projects. And obviously under the EU, when the EU came through this originally, they effectively reduced the risk weighting for SMEs. presumably this would push up the cost of, I mean, it's inevitable, it will push up the cost of lending to SMEs and to infrastructure projects.
Well,
is that desirable?
We are, one thing and then a bit of history, we are in a consultation, so we want evidence, and we've asked the banks to provide us with their evidence of what the measures would do in that sense versus the current thing. So I think the answer to that question, and I can speak for Sam Woods now, I'm sure, we will be very happy to come to the committee and lay out that evidence and put it right to you and put it before you, because it's important. Just a bit of history. So in the earlier implementation, in the Basel III implementation, the EU did not implement Basel properly and has been judged by the Basel Committee to be non-compliant. Of course, the UK was a member of the EU at that point, so we had to implement the EU rules. Now, Basel 3.1 amends the SME and infrastructure regimes to reduce the capital requirements. By the way, actually, that's mostly applying to the standardised approach. Obviously, if you're on IRB, that's a different matter. For the big banks, it's a different story anyway. So Basel 3.1 reduces it. So our proposal in the consultation is to implement those reduced Basel numbers. The EU, as I say, did a special thing on Basel 3.0, and we think they intend to continue those and not implement Basel. You probably read there's quite a dispute now between the regulators and the authorities within the EU on this question. But the key thing is that in the consultation is we want the evidence of how these regimes compare, and then we'll be able to assess that, and we'll be completely transparent about that to you. Happy to do that.
Okay, great. That's my
Thank
question.
you very much, Anthony. Danny. Yeah.
Great, thanks. We've discussed earlier the supply side and the inability of interest rate changes to significantly affect, or at least affect sort of precise changes there. But I'd be very interested in your general view, whichever of you want to jump in on this, on the challenge that the UK faces. We have this chronic productivity problem in this country. We've never recovered from 2008. And in the absence of any Labour colleagues here, I thought I might ask a slightly political question to you. I was interested in reports that this reshuffle we've just had and the moving around of ministerial departments, that the Prime Minister initially offered the Science Department to Michael Gove. I'm not asking you to comment on that. I don't even know if it's true. But what I was struck by was the suggestion that the Science Department should was a senior new Department of State to the Levelling Up Department. And the implication that what the UK needs most is a revolution in science and tech rather than the levelling up agenda. I'd just be interested in your views, without getting into the politics of that, please don't feel drawn, but in terms of challenging the UK's productivity challenge, would you prioritise investment, policy, political support into R&D, technology, science, or into the rebalancing of the UK economy to make sure all the regions of the country are growing well? And how would you distinguish between those priorities?
We're lucky enough to have a real expert on the subject here. It's not me, it's Jonathan, so don't mind, I'll let Jonathan come in first.
It's very kind and very flattering of you, Andrew. A couple of things on this, if I may, so thanks for the question. One is, I've always thought one of the good features of the UK is that actually science policy has been remarkably stable. And I can be very non-political about this, because I think credit should be given to David Sainsbury, who was on the Labour side, and David Willits on the Conservative side. The two of them, I think, ensured that a lot of science policy was kind of taken away from the politics of all of this. So I think that's a good part of that. And we certainly have lots and lots of academic evidence and practical evidence that the benefits of having a strong university sector and a strong research base flow quickly. Maybe not quickly, but they certainly flow over to the private sector as well in terms of boosting productivity. So that's one set of remarks. Second set of remarks is, I guess the priority would be around investment. So again, if I could take us back to the report in chart 3.7 on page 87, you'll have seen that we've got a diagram there about investment in the UK. This is business investment, I should say. There are lots of different measures of all of that. And essentially, business investment was sort of steaming along up until 2016, and unfortunately, it's more or less flatlined since then. So the one, if I had to sort of boil boil a complicated issue down to one thing, it would be encouraging those types of investment. Would be
but you're not particularly interested in where they go. You have a spatially blind attitude to business investment, do you? As long wherever the greatest returns can be realised, rather than thinking about investment in places other than Cambridge, which is
so the issue.
Wrong with Cambridge.
So the issue with investment is the the investment which is going to give us the biggest bang for our buck in terms of productivity is probably intangible investment. That is to say R&D and design and software and all of those kind of issues. And intangible investment does the best job when it's in a cluster with other like corporations who are also making intangible investment, because the R&D scientists can get together with other scientists, the software writers can get together with the movie makers to make the CGI stuff and all those kinds of things. So I think inevitably, given the cluster benefits from that type of investment, then the benefits of that in terms of sort of the immediate kind of overall will be concentrated in towns and cities, which takes us then to issues around planning when we sort of worry about policy. Yes. Now, of course, once we have this investment and the cake gets bigger, back to the earlier discussion, then society can choose as they wish to distribute the cake, around to whichever parties they want to distribute it. And as Hugh was saying earlier on, that's not a question for us, that's a question for you.
When you say distribution, do you mean through what? Through welfare spending?
Oh, yeah, through the tax system,
services,
through welfare or public services or whatever.
I mean, that feels like the old model, which is that the South East generates income for the Treasury, which it then hands out as sort of compensation to the places which weren't involved in the production of value in the first place.
I'm not saying whether that's right or wrong. I'm just saying that because of the characteristics of this rather powerful form of investment, because they, as I say, that they get their most bang for the buck when they're clustered together,
yes.
I think inevitably those benefits are going to be generated at a quite geographically
Okay, but do you think there's a role for government in creating or encouraging clusters in new places that not the traditional centres of development and growth? And how effective do you think it would be for government to say we're going to create a new sector cluster in a place which hasn't had one traditionally? What do you think that's doing?
And Andrew's looking at me because this is not really monetary policy.
He's an expert at the subject.
I'm off our narrow brief, but if I could just offer a view, I think there is some benefit in that. But I think what we know about cluster policy is it takes a very long time. So Stanford University, for example, is an amazing cluster out in Silicon Valley. But 100 years ago, Stanford University was referred to as the farm. Nobody went there, and it was almost an unknown kind of university. So these things take a long time to bear fruit.
Okay, well, thank you. Can I just to finish for me, maybe one for the governor, and this does range rather broadly beyond monetary policy, but it's related. And you might want to comment on Brexit in this context if you like, which is, and I noticed hearteningly that you think that although there have been undoubted impacts from Brexit in terms of obviously political distraction and significant uncertainty for business, I think the reduced divergence was the phrase from in terms of growth with trade with the EU versus trade with non-EU countries. So maybe things are looking up. If you would like to comment, I'd be delighted. Or maybe you can conclude that the effects of Brexit are, as you might put it, transitory. So any thoughts on that? But I really want to hear from you on the overall model that, in my view, was rejected by the Brexit vote and by the majority of the country. And it refers to our conversation just now. For 20 years, we've had an economic model dependent on cheap credit, printing money from the bank, cheap labour from immigration, high immigration policy, and cheap imports due to our strong pound. And all of that, in a sense, has had some benefits to some people, but for the majority of working people in this country, it has not been helpful. And as a result, they voted to change that model, not just to leave the EU. It was a more wholesale rejection of the economic model that we've had for so long. Do you accept that your mission as part of economic policymakers in this country is to help make that decision successful and therefore to make Brexit work? And how are you doing that?
Well, let me say two things to start with. I've said this many times before. As a public official and a servant, I'm neutral per se on the issue. Second thing to say is, I've said this many times before, as you rightly say, it was decided by the people in a referendum. It's our job to implement and where it affects us to implement the policies that follow from it, and that goes back to the discussion we were just having on financial regulation, actually. So we're very clear on that. I mean, that's very important. On this question, I mean, you raised about trade. I think our staff have done a lot of work with ONS and HMRC on the trade data, because it's been it's been very hard to interpret some of the trade data because there's been a shift in the method of collection. The conclusion of that work is that the effect of Brexit on trade, which we have said for some time we thought would be initially negative, has come through possibly more quickly than we thought it was. Doesn't mean so it'll be bigger, just means it seems to have come through more quickly. As you rightly said, that we've said for a long time, there will of course be over the longer term an adjustment of the real economy to that. The economy will adjust. That's natural. It will be supported, no doubt, by public policy to do so. So in the initial phase, we think it's probably come through rather more quickly based on the work our staff have done on trade data so far. That's the only conclusion we have, and we've factored that into the monetary policy assessment because we do believe there's a relationship between openness and productivity. So that productivity, that shock to productivity that we've had in our assumptions for some time now hasn't increased, but it has come through probably more quickly.
Okay, thank you.
So our role in the economy is framed by the remit. So we need to get inflation to 2%. That's our contribution to the economy. And the MPC has a track record of having achieved that 2% inflation over its 25 years. As we said before, we've been shocked by unprecedented shocks, COVID, the war in Ukraine, and so on. And the role of the MPC in that setting is to return inflation to target sustainably. And that's our part. We cannot affect the productive side, the supply side of the economy. That's for government to do. Our role is to stick to the 2% target in the medium term.
Okay. Thank you very much. Thanks.
Thank you, Danny. And I just want to conclude with the subject of quantitative tightening and quantitative easing because, as you know, we launched an inquiry into that last week. And it was striking, I thought, that in this monetary policy report you mentioned simply that they exist as tools. You didn't really say anything more about them. And I just wondered if you did at all discuss them in the meeting itself.
Well, our normal practice is to comment on that in the minutes of the meetings, actually, where we do get, obviously, reports from the staff on the operations that have been done, where it's got to. We set a target for quantitative tightening over a year, so we're not going to vary that target. So we're not at a point when obviously the committee will have to reconsider that when we get to that point, but we're not at that point at the moment. So the operations, to the extent we cover them, it's in the minutes. Now, we've been conducting those operations now since November, and so far I would say, they've been, very, very smooth in that sense.
And you're at 827 at the moment, is that right?
Yes, around about that. Yeah, it's 820, somewhere between 825 and 827. Yes.
Okay. And then the 19.3 billion that you bought just to stabilise the markets because of the liability-driven investment crisis, which is obviously separate. Those have now all been sold.
They've all been sold, yes.
And have you found, as a result of being able to sell those, I think it sounds like relatively easily, has that informed what the operational team are doing in terms of the quantitative tightening at the moment?
It has. We sold the 19, just over 19, using a different approach, actually, which was in the quantitative tightening gilt operations, we do auctions and we name the amount. We did the 19 plus on a basis of what we call an open book approach, where we set the price and said, what do you want? Yeah. And actually, we sold it very quickly, actually, and we started towards the end of November and we're done mid-January, 12th of January, I think was the last one. Now, what I would say is this: it hasn't changed our view on how we do the gilt process, auctions process. We've set the objective of £80 billion of reduction, and that's both through the active sales and the runoff for the first year, and we will stick to that because it's operating smoothly. It's not disrupting markets. Indeed, I would say markets are now more stable than they were a few months ago. But we will then review it. Now, we have got a second set of sales going on. We're gradually selling off the corporate bond portfolio. That's 20 billion. And we have taken over some of the lessons from the 19 billion sale process into that sale process as well.
You've sold all the corporates?
No,
did you
it's
say?
not all gone yet. No.
No, out of the 20.
Out of 20, I think we're about 45% of the way through at the moment. I think.
Okay, and then plus there's the 80 on top of that, and then there's
Yeah.
the 19.3 that you've already
Yes.
done. And in terms of how that experience now of some quantitative tightening, you know, one of the great unknowns in terms of quantitative tightening is what it equates to in terms of a monetary tightening, a monetary policy tightening. Are we any more informed on that at this point?
Hugh may want to come on this. I don't think we have, we don't have enough systematic evidence yet. Sorry, I thought we don't have any systematic, it's a bit early for that, frankly. What we can observe, I'll just finish off, is obviously market reactions to it. We are not seeing any, what I would call market disturbance. We look at the conditions in markets around the auctions. We look at measures of liquidity. So bid-ask spreads have come down, for instance, during this period quite a bit.
I don't have much to add on that. I think there has been emphasis on what Andrew has described, and maybe in the way you phrase the questions on, if you like, the operational aspects of this. I think from a monetary policy point of view, it is a more slow-moving business. We anticipated that because effectively, and reflecting the fact this is not at the front and centre, the discussion in the monetary policy report, that quantitative tightening would, if you like, run a little in the background on this lower frequency, year-to-year basis, not be so much in the month-to-month, meeting-to-meeting basis, where we would focus on using bank rate as the active instrument. And of course, now bank rate has moved to a level where we have scope to move it in either direction, which has been part of the discussion this morning. So that, if you like, validates this in the background approach. I think there are different views on the committee, so I should recognise that. My personal view is I would expect the sale of these bonds to have some effect on market pricing along the yield curve. I think that is very difficult to quantify. And of course, there are lots of other things influencing the market yield curve. And I think that should not be a concern for the conduct of monetary policy focusing on the use of bank rate as the active instrument, because, as is the case with all our decisions, we condition our monetary policy stance on developments on all aspects of the economy, including asset prices, including the state of the yield curve. So that's the sense in which, although it's an interesting kind of academic question, how has quantitative tightening affected the yield curve? From our point of view, because we observe the yield curve, we can still set monetary policy using bank rate.
Hugh, you mentioned that transmission mechanism. There's also the fact that the quantitative easing, it used to be a profitable exercise for the Treasury, and you used to hand back the profits, and now you're projecting that there are going to be losses and that the Treasury is going to have to absorb those. So that's another way in which presumably there could be some tightening experience through this change in direction.
What I'd say to that is, what has happened in terms of the cash flows is not a surprise. It was always envisaged that there would be a point at which those cash flows would turn negative. And it's really, I think, a fiscal decision, which is a decision more for the Treasury than for us, to work out how to incorporate that in their own fiscal planning, of which this is one part. So I would say this probably isn't a monetary policy implication of all these things, but it would be on the fiscal side.
But it does tighten fiscal policy, which might have a monetary implication.
I would be cautious about saying that, because, of course, through time, we have transferred a lot of money to the Treasury. All the coupons that we received on the bonds that were held have already been given to the Treasury. So what the Treasury did with them, maybe they paid down debt, maybe they spent them. These are things that it's not for me to comment on. That was a fiscal decision. And of course, just as it wasn't for me to comment on that side of the operation, I was not at the bank at the time, but I wouldn't have commented on them anyway. It's not really for us to comment on the other side. So that is, I think, a fiscal question.
It's about it's 123.8 billion pounds that we transferred over in cash flow. Yeah.
It is.
Yeah.
And how does your approach differ, Governor, to the approach taken by the Fed now that they've reached the same inflation point and the European Central Bank?
Well, the difference with the Fed is that the Fed has a much shorter duration book of assets. And the main reason for that is because the US government debt has a much shorter average duration. UK government debt has a longer average duration than many other countries, which in many ways obviously is a good thing, actually. And the bank's decision right at the outset of quantitative easing going back to 2009 was that we would be neutral in terms of market impact. And so essentially they bought in three buckets, short, medium, long, really to replicate the stock of gilts in issue. What that means is that because we've got a longer average duration on the book, if we were to rely on the approach the Fed can take, which is passive runoff, it happens very quickly. Obviously, the process would take a much longer time. And that's really what has led us to, therefore, to conduct active sales, which is different from certainly the Fed's approach. If I can make one more point, it might be useful, I'm just happy to come back in the inquiry, which, by the way, I think I'm very much welcome the fact that you're doing this. I think it's important to keep this under review. In terms of the total stock of assistance that we provide, and 825 is as you said earlier, is not a bad way of looking at it. We will not take it down to zero because we can't, because there's a demand, there's an equilibrium demand for reserves in the banking system. Because reserves are the other side of the balance sheet. Now we don't know what that equilibrium level is because I can tell you two things. One is the number we have at the moment is higher than it is, and the number we had before the financial crisis was way too low.
Yeah.
It will settle at some point. We will then have to decide what the right, in a sense, mix of short-term repos and outright holdings is to match that. So we will have a decision to take, and the Treasury will have to be part of that decision. But I just want to caution that the idea we'll sell from 825 to zero, that's not.
Yeah. No.
And there will have to be an adjustment done at that point, but just bear that in mind.
No, and we obviously will take more evidence on this because this is going to be a topic of interest to the wider committee. But I think at this point, I am just going to thank you for your time.
Sure.
I think that it has been extremely interesting to explore the thinking behind where we are, the role of hindsight versus contemporary evidence that there were of the risks to the upside on inflation. And, just speaking personally at the end of the session, I still think the factors that led to an upside surprise on inflation are potentially still with us in terms of the secondary effects in the economy. And I know that you note that in your monetary policy report. Inflation is the worst tax that we can inflict on the economy, and it hurts the poorest the most. And therefore, I just would conclude by urging you to remain extremely vigilant about those becoming more embedded in the UK economy. And so thank you very much for your time. Order, I declare this session over. Thank you.
Thank you very much indeed.
Thank you.
Very
Thank you to my
illustrative.
two
The proceeding has ended. The proceeding has ended. The proceeding has ended. The proceeding has ended.